Hey there, it's Mitch Goldberg. It's time for Be the Boss of Your Money. You know, if it's 4:30 Monday through Friday, I am live streaming to you. This is Be the Boss of Your Money. This is my live stream. It's all about investing, personal finance, making educated, informed decisions, financial decisions, so that you could make better decisions, so that you could be the boss of your money, because it's so easy to lose control and let your money become the boss of you. Stimulus. We're talking more stimulus. The child tax credit started going out today. Tens of millions of direct deposits went out today. People all over the country, probably like 90%, about 90% of all households have gotten some money today. There are people with literally 3 or 4 or 5 or 6 kids at home who are 17 and under who qualify for this tax credit. It's going to have an impact. I think it's going to have a big impact on retail sales. I think it'll have an impact on the economy for the rest of the summer. I think we have a very good back to school season coming up. It's already been expected that we'd have a really good back to school season coming up, because kids have been out of school, kids have outgrown their clothing. It's been like, a year and a half. It'll be like this back to school season coming up will be at 2 years since we had a really good, legitimate back to school season. This could be the biggest back to school season in, easily in the last 10 years. I also want to talk to you about a quick update in the market. It's kind of quiet, why it's quiet. And I want to touch a little bit about something that some of you may consider controversial. That is when government largesse is doled out, there are consequences to it. Money is not free. It seems like, I got money in my checking account. Hey, right. If you did, good for you. But it's not free. Eventually, we have to pay the piper in one way or another. So there are unintended consequences. So what we're going to do is we're going to roll the intro real quick. While you're watching, if you have any questions, let me know in the comments below. Personal finance, what we're talking about today, investing. I love hearing from you. It's my favorite part of the show, whether you're watching in the live stream or the replay. And let's roll the intro right now. Here we go. Okay, we are back. It's so nice that you chose to spend some of your time with me. I really appreciate it. Look, I know your time is very valuable, and the fact that you are spending some of it with me means a lot to me. I know you could do much better things with your time at 4:30 on a summer day. So we're going to get into this. I just want to give you value, but the best value is when you ask me questions. I get giddy when I hear from you. We have somebody out there. We have Carmine D. Domenico. Good afternoon, Carmine. Hey, Carmine, where are you tuning in from? Where are you at, man? I appreciate it. And thank you for being my LinkedIn connection. It means a lot to me. Thank you very much. I take my LinkedIn pretty seriously. And folks, while you're watching this, give us a reaction, a thumbs up, a heart, whatever, because then I get to see your name and I get to, give you a shout out, and it's fun. If you don't want to, that's okay. You don't have to. But if you have any questions, I love hearing from you. Words of wisdom, words of encouragement are always appreciated. Oh, okay. Carmine is in East Northport. Okay. You're right near me. You're like, I would say 5 minutes, maybe 9 or 10 minutes away. I know where East Northport is. I was just going by the DSW shoe store up on Jericho Turnpike through East Northport today. I was driving down Jericho, and Rebecca is out there. You love the Bulls and the Bears. Thank you so much. Aren't they cute? I appreciate it. Yeah. So I needed some soundproofing. Yeah, we're neighbors, Carmine. So Rebecca, I needed some soundproofing because it's just hardwood desks, that surrounds me, and so I figured plushy animals would help with the acoustics a little bit. Plus, bulls and bears, it's a good motif for me. Yeah, but they are yeah, they're cute little guys. These are the National Geographic ones. So I support National Geographic when I buy these. Bulls and bears. Thank you very much. Yeah, Carmine, we're practically neighbors. So I'm at 290 Broad Hollow Road. I'm in the Bank of America building on the corner of Route 110 and the Long Island Expressway. So give a call sometime, stop by, say hello. I'd love to meet you in person. Okay, so a couple of things going on. This has been a pretty sanguine week. Now, I've been using the word sanguine all week. So I'm thinking sanguini. Like I want to have sanguini with white clam sauce. That sounds pretty good. I'm getting a little hungry, actually. So, by the way, if you give us a like, a thumbs up, I just as a future gift to you, will show you a picture of a really, really cute bunny rabbit in advance of you giving me one of these and letting me know you're out there. Here you go. That's a cute little bunny rabbit. Okay. No, that is not my bunny. I do have a bunny rabbit. My daughter has a bunny rabbit. We love this little guy, but no, this is a different rabbit. So the markets were very flattish today in spite of a really good start to earnings season. Companies have beat earnings by about 18% on average so far this week. I'm talking about the S&P 500 companies that have reported so far, and yet the average stock that has reported is down 0.53%. And why is that? It's because, earnings this quarter were expected to exceed analysts' expectations. But the problem is, if we expect earnings to exceed expectations, then the exceeded amount was already expected. I'm kind of going in circle. I'm talking circular, but it was all expected. It was all factored into the market. And where are we now? Stock prices are up. And now the company, the actual underlying company of the stock, their earnings and revenues have to grow into the price of the stock. And I think as a result, you get a bit of a flattish market. Even though the S&P did hit a new high yesterday, it was barely, and it doesn't feel so new highish because so many stocks are not doing that great. It's just a smaller and smaller group of stocks lifting the whole market, masking smaller companies, including S&P 500 companies that are not really doing that great. And you could take a look at some of the airline stocks, for example, like Southwest, it's just GE, Ford, and a number of other stocks. It seems like they just go down like every day. The reopening stocks, we're going to take a look at some of these stocks in a couple of seconds. Thank you very much, Rebecca. We have someone out there. I really need to look at these questions before I pop them up onto the screen because you never know what someone's going to say. But to this LinkedIn user, great question. How it affects the economy. Many people and elected officials are asking for transparency. We can only hope that this will help the economy and help families. They're hoping to return to the pre-COVID economy in times. Absolutely. Absolutely, man. Yeah, you or girl. When I say man, I mean everybody, all inclusive. He, she, they, everybody. Okay, because this is an all inclusive show. All right. All right. So let's take a look at that. So that's why the market has been so sanguine. Hasn't done anything this week. It's been a really flat week. But next week and the week after, earnings season really ramps up with more than half of the S&P 500 companies reporting earnings. By the way, you can't invest directly into an index like the S&P 500. Did you know that? You could invest in a security that tracks or mimics an index, but not directly into the index. I know a lot of people think there's no difference, but I have to say it. And sometimes there is a difference, either in expense ratio or some indexes mimic an index. Some index funds mimic an index by buying most of what's in the index, but not all of the index. And sometimes there's a little tracking error. This is like a little inside baseball, and I didn't mean to get into that. So let's do a quick run through on some of the buys and sells. Okay, so today we've got some news out. Goldman's, let me see, before we get into that, let me get to the top of the list. Okay, so Oppenheimer reiterates Citi has outperformed. Morgan Stanley raises price target on Apple to 166 from 162. I mean, for such a small, 4-point target raise on a stock that price, I'm not even sure why anybody would bother. Jefferies reiterates Microsoft as a buy, but doesn't everybody already own Microsoft? JP Morgan reiterates Twitter as a top pick. Twitter stock has done phenomenally well. Raymond James ups Delta to strong buy from Market Perform. Goldman Sachs initiates coverage of Weyerhaeuser as a buy. This is a new buy recommendation. Defensive, as we estimate, its Timberlands comprise 75% of the enterprise value of the company. UBS raises a target on Netflix from to 620 from 600. That's a big move. That would be a big move. Goldman Sachs reiterates CrowdStrike is a buy. Jefferies raises a price target on Moderna to 250 from 170. Bank of America reiterates Facebook as a buy. I didn't know if there was anyone left who doesn't own Facebook. And that's part of the issue with the market is that these stocks are so overowned already. But this is like the big call of the day. This call got its own like headline today on CNBC. Mizuho reiterates Square as a buy. And it said, this could make buying Square. Okay, it's another Jack Dorsey company. He founded Twitter as well. This could make buying Square analogous to buying JP Morgan in 1871. I mean, that's like one heck of a thing. It's one heck of a buy recommendation, wouldn't you say? That's pretty huge. All right, so that's a big buy recommendation. So if it hits, we'll give one of these. Yeah, I like my little, sound effects. Makes it more fun. What else? Quiet day tomorrow. So I normally don't stream on Fridays. There would have to be like something major going on in financial markets for me to stream on Fridays. And the reason for that is I used to stream Monday through Friday, and then around June of last year, I realized as the weather gets nicer, fewer people were watching the live stream, and it's rough. Like I needed a little bit of a break. Like it was just too much to do it 5 days a week. Doing a live stream every day, and I mean, I'm very comfortable. I'm super comfortable doing a live stream. Very comfortable. I'm not camera shy. I enjoy it. I love the back and forth, the banter, but it is a lot to do every single weekday and think of things to talk about and what you're going to say. Make sure you know what's going on in the world. It's just tough. Hey, Phil, thank you so much. Phil is in the house. Phil, I think you're going to like a topic we're going to talk about a little bit, consequences of government largesse. And there are some negative consequences that we need to consider. Can't all be like rainbows and unicorns, right? I mean, people, there comes a time when you actually have to earn your money and, work for it. There comes a time. But I don't want to come off either, I don't I'm just trying to be, down the middle here. But seriously, we have to talk about consequences. So thank you, Phil, for joining me. And so quiet day tomorrow. But it's a Friday in July. Weather should be okay. I don't expect anything happening tomorrow. So if something crazy happens in the market, then I'll definitely jump on the live stream, or maybe I'll do it Saturday morning and we'll talk about it. But I do send out a blast email every Friday, and I include the highlights from the week's live streams. So if you want to get in on the email blast, let me know. You could let me know your email address in the comments or send me a DM. I'll sign you up. It's there's no sales in it, nothing like that. I don't share my email distribution list with anybody. It's just for my business use, for my tribe. Okay, let's take a look at the market today. Pop myself up in the screen. Okay, so the Dow was up 53 points. Nasdaq was off a little bit. S&P was off a drop. Gold, it's moving up a little bit, showing a little bit of strength, but oil is coming down. It was just like 75, 76, and it's getting a little weaker and a little weaker. I feel like oil is a little toppy myself. It's my opinion. And I think a concern is if OPEC plus, that's OPEC plus Russia, come out and actually decide to agree to raise production, oil, the price of oil is just, it's going to get slammed because all of a sudden we're going to flood the world with it. We do have a lot of oil. It's just in the ground, but it's not so hard to extract it today and raise production. We've got a couple of other things going on. The VIX, we talk about the VIX a lot. The VIX closed at 17. It's still under 20. So as long as it's under 20, I think we're having a pretty sanguine market. Man, I could go for some sanguine with white clam sauce. I think I'm so funny when I say that. I crack myself up. Let's take a look at the Russell 2000. That continues to be weak. Small cap stocks are down. The Russell 2000, okay, that tracks smaller cap stocks. Commodities put in a mixed picture, but this is, I think, the most concerning thing in all of financial markets. The most concerning thing is the 10-year yield. The yield on the 10-year Treasury is down again to 1.3%. That is such a strong argument to say that inflation is real, or real transitory, I should say. That is such an indication that says inflation is transitory, because if it wasn't, we would see the 10-year Treasury yield go up. And with all of the issuance of all the bonds and the money printing, Fed's buying $120 billion worth of bonds and printing $120 billion a month to do that. And yet there's still demand for U.S. Treasuries. It is a little frightening to see. I really believe that it's a real negative sign to see the yield on the 10-year Treasury just get crushed every day. It's just pounded every day. I mean, about 5 months ago, a friend of mine, Jonathan, was asking me, "Hey, Mitch, where do you think the 10-year Treasury yield is at by the end of the year?" And I was like, maybe we could get to 2.5%. That is right now so off the table. I mean, it's like half that now. It was up to like 1.78, 1.79% about 5 months ago when we had an inflation scare. And it's just really difficult to make any decisions because our usual indicators of Treasury securities seems either the indicator is broken and it no longer works, a 10-year Treasury yield, okay, or there's something going on that we haven't seen yet in the economy. I know that the New York region had a record manufacturing output. The numbers came out today, and Philadelphia region had a pretty strong manufacturing report too. It moderated from the previous month, but it was still pretty good yield. And now with the child tax credit money going out, that should keep things going. All right, so that's that. Let's get back to the share screen. Crypto. I come to you every day with cryptocurrency. Make sure I didn't knock the cable out. I come to you with crypto every day. Cryptocurrency. We check it out every day, and it's a big topic of conversation. But if you look at crypto, it's a sea of red. Look at all this red. Can you see that on your screen? But Bitcoin down a little bit over $1,000 a coin. All right, down 3%. Dogecoin, which is a total joke. I feel like I'm doing like a disservice by even talking about it, except that yesterday we're looking at it was 20 cents. Now it's broken 20 cents. It's 18.8 cents. One of the two founders of Dogecoin said that he's not even interested in being invested in crypto because he thinks it's like such nefarious stuff going on and is not a believer of it. By the way, the founders of Dogecoin did not make money on the surge in Dogecoin. They had already unloaded it way before, it got popular and before Elon Musk touted it and said, "Hey, this thing is real." It's not. It's like you've heard of magical beans. Crypto is like, especially Dogecoin, it's like magical electrons. And just because something is difficult to mine or create a digital coin, that alone does not make it a valuable and viable currency. By the Dogecoin, it's not that hard to mine it. It's nothing like Bitcoin, and like 5 or 6 wallets have almost all of the Dogecoin. So it's a super concentrated market, and it's not in enough hands to make it a real market, is what I'm saying. Okay. But look, I might not even talk about crypto that much more because there just seems to be no interest in it. It just seems to be a moribund market, and I feel like I'm wasting time on it. So I might not be talking about crypto for much longer. Okay, let's take a look at some of the reopening stocks, because reopening stocks have been getting hit. Cinemark Holdings, Norwegian Cruise Lines, all down, percentages. Southwest Air keeps going down. American Airlines keeps going down. If you look at Southwest, it was up to almost 65, now down to 51. And I'm a fan. I'm a fan of Southwest. Okay, good airline. I think it's fine. Delta was up a little bit. They got an upgrade, but still from 52 down to 41. These stocks are really moving back down to the midpoint, where a lot of them are already below the midpoint of their 52-week high and low, according to this chart over here. Okay, let's keep going. Top performing sectors: utilities, consumer staples. Yeah, when people are worried about an economic slowdown, that's when they start getting into utilities and consumer staples. Industrials and financials, they were up a little bit. I mean, there's more to me like a bounce than anything significant. But energy has continued to come off its high. And it's actually energy, the XLE, that's the ETF that tracks the energy space. That is down now by more than 10% from its high. That's significant enough to be worth mentioning. Let's talk about stimulus and consequences. I don't have like a whole Shakespearean soliloquy, and I'm almost through our time. I'm almost going to be at the time limit that I like to set for this live stream. But there are consequences. But there are consequences of government largesse. And before you at me, don't be atting me, okay? Don't at me here. There are consequences to printing money, to the government handing out money. Now, I'm not one of these people who is anti-government help. I don't think we should gut Medicare and gut Medicaid. I'm actually very pro-Medicare and Medicaid, okay? Some people say that's the worst thing we've ever done for this country. And then we have to talk about student loans, and then we talk about the CARES Act, the PPP loans, and today the child tax credits went out, and tens of millions of bank accounts received a direct deposit for the child tax credit. So lumping them all together, and there have been many others, some people feel it could create a moral hazard, meaning that maybe consumers and investors will take too much risk, more risk than they could afford to take, because they expect to get bailed out. Now, the government bailed us out of the pandemic with its largesse, the CARES Act, and other major programs. trillions and trillions and trillions of dollars. So we had a bailout. So did investors learn their lesson of buyer beware? Because if you're an investor, it should always be buyer beware. You're taking the risk, and it's the risk is what creates the long-term return. But risk is really skewed now, especially with interest rates so low that baby boomers and seniors, and I hope I don't insult too many of you baby boomers, but you guys a lot of you are actually seniors now. Hey, listen, I'm old enough to have an AARP card. Okay, so I'm right there with you. I'm not throwing shade at you. Okay, but it does create a moral hazard in that regard. Investors expect to get bailed out. The other thing is, people are getting money, presumably who need the money, and I believe in that. I'm not against the child tax credit, but as long as we could borrow the money cheaply, some people are going to howl at this. But if it was a problem for the economy and for the bond market, then why the hell is the yield on the 10-year Treasury down to 1.3%? I mean, the cost of money to the U.S. government is so low, the interest rate expense is incredibly low. So that is one thing that we have to take all of these things into consideration. But consequences of raising Social Security, and now it looks like the Social Security benefits this year are expected to be raised by 6.1% because of inflation for the COLA, cost of living adjustment. So some people will say, well, if you keep giving people more money, the price of everything will keep going up. And I look at student debt like this. And I've had this talk with lots of people, and I think it makes a lot of sense that let's say the government makes 10% more borrowing capacity available for college. The colleges just raise their prices by 10%. So you never really get ahead of it. You never really get ahead of the inflation curve. You don't even bend the inflation curve in terms of the cost of a college education. You just make it go up with more largesse. So that's a downside. Am I blaming everything on social programs? No, I'm a big believer in social programs and helping our citizenry. But we've done so much social programs. At what point do we say, another $1 trillion possibly for infrastructure? Oh, great, we need it. It'll create jobs, it'll create income, it'll create more taxes. So it's not like it all goes to infrastructure, because it'll create a lot of economic activity that creates a lot of taxes, and that'll help offset a lot of it. And infrastructure is one of those things that does pay for itself with better roads, and it's just something we need. I think the child tax credit could pay for itself, but these programs grow, and when you give them out, they're not easily lost. It's very hard to take a program back. I mean, the talk is that the child tax credit, a lot of people want it to be made permanent. I don't think it's a terrible idea, but there could be consequences to that. Someone's got to pay for it. Now, we think we don't have to pay for it because interest rates are so low, so the cost of these programs is a low cost. But the debt is getting piled on, and at some point, the debt payments start to eat into the benefit of what we're giving people, and the debt will have forever. Like when the roads and bridges and the child tax credit money and the Social Security COLA adjustment is finally out for a year, 2-3 years, we still have the debt, but the products, go away. The stuff we spend money on goes in a landfill. The roads do deteriorate pretty quickly. So what's the solution? I don't really have a solution. I mean, should I have a solution for you? I mean, I'm not running for office, so I haven't really thought of giving you a solution. But I think even when we come out with a program, we say, okay, this is going to be a 5-year program. This is going to be a 6-year program. You get to the end of the program and nobody wants to let go of the programs because you get used to them. You factor in it. It's like getting a raise at work. Most people don't save the money when they get a raise at work. They grow their standard of living. It's called a lifestyle creep. And that's the way it is for a lot of these things. So, I mean, I just want you to know, I have a son who has a disability who is a beneficiary of government largesse. So I'm pro government largesse, but I was like that before I realized my son had a disability. Okay. But I just want people to be aware of, who most people who are celebrating getting the child tax credits, for example, now. Yeah, that's something to celebrate. Good for you. Enjoy it. Do well. Make your life better. Bring your kids up as best as you can, and make childhood better. But can we keep doing this forever? Are we making it? Man, some people really need the money. It's not like, look, I don't believe that welfare makes everybody lazy. Yeah, I get it. There are people in the world who are just happy to get their welfare, and that's it, and they don't want to do anything else. But I don't like to paint everybody with such a broad brush, because people are hurting. They do need it. But at some point, we are out of the pandemic. The economy is doing better, and we need to let the economy start to function on its own. And also, I hate to say, well, no, I don't hate to say it. I'm actually proud to say it. I think that at some point, you have to let investors sink or swim, because a lot of the Fed government largesse is propping up the stock market. And I don't think the stock market should ever be a factor in monetary or fiscal stimulus decisions. What happens with the stock market is a symptom of government largesse. And right now, I think I could give you all the reasons in the world why stocks are at nosebleed levels. And you have to wonder how the stock market would do without government largesse. So these are just thoughts out loud that I wanted to share with you, and they've been on my mind. I don't have all the answers. All I could say is for my clients and for you viewers out there who are not my clients, I'm going to, well, for my clients, it's an easy one. I'm going to guide you the best that I can, reduce your exposure to the stock market when I think it should be reduced, but it's based on your personal finance. And I'm happy to share these lessons with everybody else. I think it's one thing to hear it. It's another thing to do it, which is why I don't mind giving away my knowledge, for free in the live stream. I'm happy to do it and actually enjoy doing it. And, if you're a do-it-yourselfer, great. Take all the information, try to do it yourself. And when you get to a point when life becomes a little bit more busy, a little bit more challenging, and the solutions that you need to meet your financial goals require a little bit more sophistication, that's when you reach out to a financial advisor, right? Okay, I'm going to end this live stream. I hope everybody has a great weekend. I will be in tomorrow. Let me know if you want in on the email blast, and I will see you again on Monday. Thanks so much for joining me.